Hello and welcome to this new edition of the market dashboard, June 14th, 2025. This started as a pretty quiet week until Thursday night when Israel decided to strike Iran and its nuclear program. This is something that had been brewing for a couple of weeks already. I've mentioned in my newsletter that the US had relocated some of its navy from Asia to the Middle East, and considering the current negotiation between the US and Iran about its nuclear program, that if these negotiations would stall, then there would be consequences. For the security of Israel, Israel would never allow Iran to become a nuclear power. So we will review what the consequences were on the markets this week, specifically starting Thursday night. So let's go. So global market dashboard, we see the US equities were slightly up and then went down yesterday, not massively, slightly more than 1% yesterday on the news. We'll talk about treasury bonds, which were up last week, went down yesterday with a risk of move, which is again not good, and we'll talk about that. US dollar down for the week, flat yesterday on the news as well. One of the beginner of yesterday was obviously gold, since US dollar and bonds are not playing the role of safe asset anymore. We'll see that Bitcoin actually didn't move much and stayed, was basically unbothered by what happened despite the initial reaction. And of course, the big move when we talk about Iran was on oil. Oil had a pretty decent performance over the recent weeks, even though Saudi Arabia decided to increase their production. But between expectations of a trade agreement between the US and China that would push the economy, the economic activity, and then the need for energy. On top of that, now we have Iran that is also considering closing the Strait of Hormuz and block deliveries of oil. So the Strait of Hormuz is really important in that sense for the price of oil. So this is where we are now. We'll see this in closer detail now. So yesterday, what happened? So of course the S&P 500 dropped on the news, then recovered because there was not much more news than that. We have had over the last month some kind of a polite dance, I would say, between Israel and Iran. You strike me, I strike you, but something very limited, military targets specifically, and nothing that is really escalating at that point, which could change right now. So the market recovered. And then Iran started to retaliate against Israel and launch a salvo of missiles, some of them hitting Tel Aviv inside the city. So this is when the market started going down again, slightly more than 1% for the day, which is not really terrible. So mostly contained. The VIX, of course, spiked, then moved back, and then spiked up again. So I believe, in terms of VIX, there was probably two reasons for that. The move was slightly more significant on the VIX, is because not only Iran started retaliating, but also probably some investors were looking for protection over the weekend, when all the markets are closed and you have no idea what can happen over the weekend. So in this context, the main winner of the situations are, of course, commodities. So you see, so DBC is the global index. It took 4% of the week, but we had oil, which made about 8% last week, if I remember well, made another 12% this week, specifically on the news of the attack on Iran. That's not really a surprise at this point. And again, gold, that is playing the role of the real safe asset. And we'll talk about that, I believe, in a second. So we have oil again spiking, slightly going back down and slightly up, before the oil market closed yesterday. But quite a significant move. Here I show from basically the bottom is when, so just behind my head, right here, no, right here. No, here, yeah. This is when basically Saudi Arabia announced that they would increase their production. And again, it was a time that the trade war was already going back. China having conversation with the US, which probably helped oil recover, even with the information of Saudi Arabia increasing the production. And then yesterday, well, actually Thursday night came. So that's for oil. Gold, again, if you see gold, so this week I've seen, specifically at the beginning of the week, considering that the market were closing around their all-time highs, you had a lot of people say, okay, we'll go above that, but the whole time this will be negative for gold, and the gold will fall, look, they failed to make new highs, blah 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 blah. The thing is that the trend at this time, has never been broken so far. So I don't know why people were saying that gold would crash, only maybe because of a receding risk on the market. But we should not forget that gold has been going up. The main reason was the US deficit, the crisis on the US bonds, and that people are looking for alternatives in terms of dollar, which has been going down, in terms of treasuries, who have been going down as well. And there's very few other alternatives besides that, if you want a safe asset where you want to park your money. So this is what makes sense. The trend was not broken anyway. And then again, Thursday came, so it obviously gave a lift to gold on yesterday. What we can mention here is that usually in this situation of geopolitical tensions, usually the US dollar used to be a safe asset where investors are going to, but not anymore. Just like bonds, we can see that yesterday, on the news, the US dollar was flat, so didn't respond at all to the attack on Iran, and it was even negative for the week. And if you look at all other currency, whether it's euro, the yen, the Swiss franc, the pound, the Canadian dollar, were all positive against the dollar. The only one was the Australian dollar, which was negative over the week, but I think it's anecdotal at this point. The main key information is that the dollar is going down and didn't react to geopolitical tension. So back to what I was saying, that bonds and US dollar don't react anymore like they used to. If you look at bonds yesterday, it's even worse. Bonds yesterday went down on the news of the attack on Iran, and I believe it's for two main reasons. First, again, I would mention that these two bonds going down and US dollar not reacting means that investors do not trust the United States anymore to fix their problem of debt, and then in that sense they cannot be a safe haven asset at this point, whether it's treasuries or everything linked to basically the US government, and that is impacted by the government deficit and the US debt. The second point is that specifically on T-bonds, the rise in oil will generate inflation around the world and the US as well, and that's, I believe, what the reason is why bonds went down yesterday significantly, with oil rising pretty significantly. Anything linked to the government doesn't appear anymore to be a safe area to put their asset in times of tension, of heightened risk, whether it's geopolitical or economical. So again, Bitcoin, I've mentioned, obviously dropped on the news and then recovered basically around the point where it started anyway. So no impact yesterday. Some of the charts that I usually share, you see that the activity on most assets are down. Again, the only one that is picking up at this time is oil, which again is not a surprise considering the price action. Over the last 2 weeks, we've seen that so oil is recovering and its risk-adjusted momentum is recovering as well. So, and now it just passed on the positive side of the chart with, again, positive move on the oil as well. Recently, we have to remember that the only two assets that had a positive risk-adjusted momentum was gold and Bitcoin. We had, US equities were negative, oil was negative, bonds were negative, US dollar was negative. So we are limited in terms, or specifically, so if you're long short, it's a little bit different. But if you are long only, it was a clear indication that we were in a risk off mode. Now with equities, we have 4 different diversified assets, although 3 of them are commodities, which means that they are often some of the safer assets in terms of inflation and some specific geopolitical tension. So it's not really surprising to see gold and oil commodities in positive territory at this point. Again, Bitcoin is a little bit different animal, and equities, it's a good thing because at this time we have a little bit of diversification between equities and gold and oil. So that's a positive to see more assets in positive risk-adjusted momentum territory. Again, about, I think I've shown you this graph so many times already. This is long-term treasuries versus gold. So this is the spread, and just means that long-term treasuries are basically a straight line at this point versus gold. Again, this shows that investors are massively preferring gold in terms of safe asset compared to long-term treasuries. We have a similar situation here, again, which confirms that looking at the US dollar versus gold and the long-term treasuries versus gold, both of these are negative spread versus gold. And again, this means that global investors are there is a defiance for the US government and US financial products at this time. This is not the safe asset that it used to be, and because the world is changing at this time. So I won't give you the speech on geopolitics. The world is changing in Ukraine, the world is changing in the Middle East now, the world is changing between the balance of power between the US and China. A lot of things are changing at this time, and this is kind of the things that we can see in the price of major assets and that we need to relate to geopolitical situations. This chart is a couple of fiat currencies versus gold since 2008, I believe. Yes, this is basically to show you that it's an incentive to invest, basically, because what it shows you is that both the euro and yen have lost about 85, between 82 and 85% since 2008 versus gold, and the Swiss franc and the US dollar about 75%. So what does it mean? It just means that if you don't invest, this is what you'll be losing if you stay if you keep your money in the bank. And I believe this is the best chart to this is the chart that I show to my friends when I tell them, don't keep your money in the bank, invest it somewhere the way you like it, but do something about it, because the only certainty we have in this life is that every fiat currency is going to zero. So that's my little education point. Fiat currencies are designed to go to zero. They target an inflation level of 2%. This is basically what they can steal from your savings without being noticed every year. So you have to invest it. And I wanted to finish on something about the relationship between gold and Bitcoin, because again, like I mentioned before, some people yesterday were saying, oh, gold is going up, Bitcoin is going down, Bitcoin is not a safe asset. I think it's about missing the point about Bitcoin. What I believe is that Bitcoin is mostly a hedge against government fiscal irresponsibility, I would say. But it's a totally different animal. It's not a safe asset, it's not a risk asset, it's just totally something different. And the illustration here is that rolling 21 days, so about 1 month correlation between gold and Bitcoin. And what you see, it's going up and down, it's sometimes negative, it's sometimes positive. So both are actually really different. The relationship is not static. The relationship is dynamic depending on conditions, and this is what you get. So again, saying that Bitcoin is not a safe asset is missing the point, just like, or saying that it is a safe asset is missing the point. Saying that it's a risk-on asset is also missing the point, in my opinion. And the other thing that we can can infer from that chart is that you have at this time, again, and this is not an investment advice, this is just constatation about what's happening in the market. When you have two assets that are going up and are not correlated, I mean, the average correlation about, since Bitcoin started in 2011, it's, at least since we have the prices regularly, is that the correlation is about 6%, something like this, 6.5, about that. I mean, the exact number is not important. But when you have these two assets going up and that are very low correlated, then if you combine them in a way that risk is, in risk adjusted way, then you have something that can become pretty sexy. And this is what I wanted to show you, the last slide, which is this one. So you have gold in blue and you have Bitcoin in red. And they are on two different axes because I wanted to show them basically when they have the same performance, and let's say they are kind of risk adjusted so that they have the same overall performance on that specific period. I know this is not correct, so don't jump on me for that, but that's just an illustration. But it's just to show you that when you have in general two assets going up and are loosely correlated, if you combine these two, you have something that is a pretty sexy investment. Again, risk disclaimer, this doesn't mean that both gold and Bitcoin will go up. This doesn't mean that the correlation between gold and Bitcoin will stay that way. It's just for this, at this moment, this is the situation we are in. So I thought it would be interested for you. So okay, so thank you very much. I encourage you, if you have not done so, to read Ma's newsletter that you can find on LinkedIn. You'll have the link in the comments, in the description of the video below. So happy to meet you there, where you will have a bit more comment about the geopolitical situation and the economy, and this video is basically the complement to that newsletter to understand what's happening in the markets. Thank you, enjoy your weekend, bye bye.